The US dollar's strength isn't so much a function of the strength of the US economy or US political leadership, but rather the fact that we're competing in a horse race against a bunch of other horses that are completely lame. These are the words of today's guest, Rick Rule. The former president and CEO of Sprott was last on the show at the beginning of February. You know, that time when Russia had yet to invade Ukraine, or the US wasn't poking at China via Taiwan, the British pound was still respectable, and we weren't worrying about heating our homes. Goodness, even the Queen was still alive. So, given all that has changed in the last 9 months, we thought it was a good time to invite Mr. Rule back on to get his take on things. And spoiler alert, he's not here to give us a rose-tinted view. Sit back and listen to his thoughts on the US dollar, if the Fed will get inflation under control, and what he's saying to investors during these trying times. If you enjoy Dave's conversation with Rick, then you'll definitely not regret hitting the subscribe button. Our YouTube channel, GoldCore TV, is packed to the rafters with brilliant guests and leading market commentary. That's right, you're just a click away from the likes of Jim Rickards, Mark Faber, and Jim Rogers, to name a few. But for now, take a look at our interview with Mr. Rick Rule.
Rick Rule, welcome back to GoldCore TV.
David, thank you so much for having me back.
Now, we met and chatted, it's probably about 9 months ago, and the world has changed a lot since then. Last time that we talked, you talked about bonds and the bond market being a return-free risk. Now, at that stage, the 10-year US Treasury was yielding about 1.75%. And Fed funds was close to zero. Now, as I say, a lot has changed since then, and we've got Fed funds 3% higher than that. We've got the 10-year yielding about 175. We've got the dollar index at levels that we haven't seen for 20 plus years. And we've also got inflation rates at levels that mean that the real yields are still negative. We've also got what appears to be a debt crisis brewing in the UK. Are we in bigger trouble than most people actually think?
I guess it depends on who most people are, but I think we are in real trouble. Particularly, we're in real trouble if the length and breadth of the investor community returns to understanding fundamental math as opposed to narrative.
Okay.
What you talk about, which is the fact that nominal interest rates are double what they were a year ago, disguises the fact that those same interest rates are still negative.
Mm-hmm.
The US 10-year Treasury yields 4 in a currency that the Congressional Budget Office, not some cranky old bald libertarian named Rick Rule, says is depreciating by 9% compounded. What that means is, despite a doubling in the nominal yield, the real yield is still -5 compounded. Think about an instrument that takes 5% of your purchasing power away every year for 10 years. Think about how attractive that might be. The irony of it is that the US Treasury market and the US dollar, despite its obvious arithmetic challenges, is the strongest major currency in the world. I would argue, David, that this isn't so much a function of the strength of the US economy or US political leadership, but rather the fact that we're competing in a horse race against a bunch of other horses that are completely lame. The irony, I guess, is that the global outlook to some investors is so gloomy that they would prefer to lose 5% in US Treasuries than lose 15 or 20% in other debt instruments or in equities. That in and of itself is fairly scary to me. Now, I'm not a doom and gloomer, but I do think that we have fashioned some economic circumstances over the last 40 years that need to be unwound. And I think that unwinding will unfortunately be very interesting in a negative sense for an awful lot of people, hopefully not you and I.
And that unwinding is going to take longer than most people think.
I suspect that's correct. Let's, just for fun, we talked about arithmetic in the last answer. Let's look at the arithmetic around a reversion to mean in interest rates. If you look at American interest rates over the last 40 years, the mean condition has been a positive real yield, which is to say that savers have expected a real return after inflation on their debt and deposit instruments. With inflation in the United States running at 8.9, that would suggest that a reversion to mean would have the 10-year Treasury with a 10 handle on it. Traditionally, the US 30-year fixed mortgage has traded at a premium to the US 10-year. Imagine the damage that might be done to American housing markets and to affordability if the 30-year fixed mortgage ran up to, say, 11.
Yeah.
Imagine the traditional premium on revolving consumer debt, credit cards, consumer durables. They have traded at a substantial premium to the 30-year mortgage rate. So imagine the difficulty that American or British households would have if their access to revolving credit was at 20 or 22. You have a situation where a reversion to mean will be very difficult for a lot of people. And the failure to revert to mean means that savers in the Western world will have absolutely no incentive to save. I don't know how you resolve this. I'm interested as opposed to eager to find out.
It's kind of damned if you do and damned if you don't, because at those rates that you're talking about, if you have the 30-year fixed mortgage at 11%, that decimates the property market. Among other things, exactly. Getting real yields back positive is going to decimate the economy also. I mean, it seems like an impossible ask, really, doesn't it? Because I suppose the other thing to throw into that is that, you know, we've got the national debt in the US of over 30 trillion. And if rates go much higher than where they are now, you've got a significant issue when it comes to the interest payments on the national debt, don't you?
I think that's correct. Federal, state, and local governments, remember that the Fed would have you focus on the national debt, the national on-balance sheet debt, which is to say the obligation represented by treasuries. They leave out state and local debt. And importantly, David, and I don't know why they do this, they leave out the net present value of off-balance sheet obligations like Social Security, Medicare, and Medicaid. While there isn't a current interest charge on those, the Congressional Budget the Office themselves acknowledges that they're underfunded by about $120 trillion. The way that this works out is not clear to me, but I suspect that you're seeing the beginnings of it in the long-term gilt market in London, where the increasing interest rates and the tightening of short-term credits has meant that some of the largest institutions in the UK are experiencing at once funding shortfalls in their pension obligations and margin calls to the extent that they were playing the yield curve by buying the long gilt and funding it in short-term credit markets. The turmoil in the London gilt market, I think, tells us something about the challenges that global credit markets are going to face if we have persistently high inflation. The other side of the argument, I guess, is that against all odds, some of what the Fed is doing might work. In other words, they might be able, with gradually increasing interest rates, to slow the rate of inflation to the extent that the rate of inflation itself caused the yields to go positive. If there was a hint that that were going to occur, I've seen no evidence of it, but that doesn't matter. I'm not an economist. If there was a hint that that happened, there is so much cash on the sidelines that you could have a relief rally of whatever duration that would rip your face off. I'm not saying this is going to happen, but there is a lot of money that would like to deploy. And to the extent that it looked like, at least in the US, that the rate of inflation was going to slow enough that we returned to real yields, nominal real yields, as a consequence of the slowing of inflation, rather than the continued increase in interest rates, that could be extremely bullish. It isn't something that I see us being able to accomplish as I look at things, but I really need to disclaim for your audience, I'm an investor, a speculator, and a lender. I'm not an economist, and I look at everything from fairly simple arithmetic base.
Okay, two things there. So what you're basically saying as well is that there is a chance that the Fed will get inflation under control. And if they do that, we can return to positive yields by the inflation rate going down, as well
Correct.
as interest rates going up.
Correct.
We don't necessarily know when that inflection point happens and if they'll actually manage it or not. But as you say, you look at this from you're not an economist, you're an investor. Now, given what we're seeing at the moment, and potentially a developing sovereign debt crisis in the UK, that there could be contagion in the Eurozone or elsewhere, where are you putting money to work? What do you see with your investor hat on at the moment and say, this is what I should be doing?
Well, there are several opportunities that I see, all of which have challenges. I am a fairly large holder of U.S. one-year treasuries. I am among those who believe it's better to lose 5% than to lose 15%. And so I'm holding a lot of liquidity. I'm very afraid that we will experience a crisis of confidence, and that crisis of confidence will yield an event like 2008. Mm-hmm. There's no guarantee, but I think the possibility is high enough that it's a contingency that I have to insure against. The most liquid market on the planet is the U.S. Treasury market, and the 1 years at 4% relative to any other duration seem attractive to me. The other thing I'm doing, David, as we discussed before we started taping, is I'm celebrating my retirement at age 69 by starting yet another bank. The credit spreads between federally insured deposits and other forms of longer-term credits is as broad as I've ever seen it in my life. And I can't help but attempt to take advantage of that. I, too, and this will get me a lot of hate probably from your listeners, I'm a reasonably large bullion holder. And one would wonder, if I had an independent financial advisor, why I hold bullion. I'm the largest shareholder of Sprott, which theoretically should do very well in a time of higher gold prices. But at age 69, gold helps me sleep well. And I'm in the ironic position of owning a fair bit of gold and actually hoping that the price goes down. You see, if the gold price ran from US, 1650 to 22 or 2300, that wouldn't prompt an action on my behalf. I wouldn't sell gold. But if gold fell from 1650 to 1500, I'd buy a lot of gold. So I'm in the strange place where my motivation with regards to gold, given my nervousness about other forms of assets, is such that I would rather the price go lower so that I could buy more, rather than the price go up, which wouldn't condition me to sell any. I guess the last thing I'm doing, and your listeners shouldn't do this, we're in a real risk-off environment, and risky environments, and there's no riskier asset class in the world than junior mining stocks. The junior mining stocks, the sort of 150 or 200 that are viable worldwide, out of the 3,000 that pretend, are having a real capital raising crisis. And so selectively, I'm trying to go into a risk-off market and provide capital where no one else will do it, on terms that are reminiscent of the terms that I was able to receive 5 years ago. So I'm actively looking for opportunities to deploy capital among very, very, very high quality juniors in the absence of any other capital provider.
Given what you've said about holding bullion, what we've seen this year should be a perfect storm for gold and silver, particularly for gold. We've got geopolitical tension. We've got a crisis of confidence, a sovereign crisis of confidence. We've got economies around the world faltering. We've seen fiat currencies, a number of fiat currencies significantly weakening. Why aren't we seeing gold higher in dollar terms?
Well, simply because of the strength of the dollar. I would suggest. I think that investors' conditioned response over the last 40 years has been that the US dollar is the risk-off asset, irrespective of the arithmetic around it. It's important to know that 20 and 25 years ago, investors could park money in US treasuries and get a positive real yield against US inflation. I don't think yet that the reality of the arithmetic around the US Treasury market has impacted very many investors, or those same investors are so afraid of every other asset class on the planet that, like me, they prefers to lose 5% real as opposed to 15% real. The circumstance that we find ourselves in today, David, reminds me of two prior circumstances that I personally lived through. One was 1975, where the US Fed raised nominal interest rates in the United States, greatly strengthened the US dollar, and cut the gold price from $200 to $100. The resulting damage in the US economy and the political reality of a democracy meant that towards the end of 1975, the Fed lost their nerve and backed off. And when that happened, gold went on a 6-year romp from $100 to $850. Similarly, at the end of 2001, the beginning of 2002, we had a circumstance where US interest rates rose, and gold was doing well in every currency in the world with the sole exception of the US dollar. Again, the Fed had to reverse course. And when the Fed reversed course, gold did very, very, very well. I'm not suggesting that past has to be prologue. I'm not suggesting that any of your listeners have an overexposure to bullion. I know lots of people that are 100% involved in bullion, and I think that's madness. But I also think that having no exposure to bullion, if you're a saver, if you have some portfolio to protect, is a necessity. Make no mistake, a negative real interest rate was described by Franz Pick as a certificate of guaranteed confiscation. It is not good arithmetic.
And as I said, we're seeing the dollar index at levels we haven't seen for 20 plus years. At what level or at what stage? Well, first of all, do you think that it will strengthen further from here? And at what stage does that actually become a problem for the US?
It seems as though there's enough residual strength in the US economy, and particularly that the global narrative is that the US economy is a strong and functioning community. It would seem that the Fed can continue to allow interest rates to rise gradually in the near term. And if the interest rate differential between the United States and Japan, the United States and Australia, the United States and the pound, the United States and the euro, never mind the United States versus emerging markets, which are basically, with regards to liquidity, uninvestable. To the extent that continues, the US dollar strength continues until it doesn't. You may remember yourself concern in credit markets beginning in 2006 about the state of sub-investment grade bonds in the United States and real estate securities in the United States. I remember myself driving to Los Angeles Airport, seeing a billboard on the right side of the highway that said, borrow 125% of the value of your house. Bad credit, okay. I'm not a real estate guy, but I looked at that sign and said, I don't like the sound of this. Did I do anything about it? No. Did anybody else for the 2 years between 2006, 2008? No. The trend in motion continued until it didn't. But when it didn't, the disruption was fairly violent. What I learned from that is to look at today's circumstance as an example, and any sub-investment grades credit that I myself haven't structured or that wasn't structured by Sprott, I've sold.
Right. Okay.
Maybe I miss out in 3 years opportunity cost with regards to excess interest. I'm okay with that. Foregone yield as opposed to destruction of principal is something that at age 69, I'm very much in favor of.
Helps you sleep at night.
It does.
And whilst the subprime mortgage market was very much the Achilles heel of the US economy back in 2006 to 2008, what do you think the Achilles heel might be now? Where do you think that
Junk credit.
Junk credit.
Junk credit. I mean, we had this credit binge with people looking for yield. And there's been a structural change in the credit market that many people don't recognize. A lot of that junk credit now is held in ETFs. It's held by retail investors.
Okay.
The instrument that they own is highly liquid, but the instrument that's owned by the ETFs is highly illiquid. And if you have something that scares retail investors to disintermediate, to begin to pile out of that asset class, which is junk credit, it's unlikely, I think, that the ETFs will be able to sell the underlying credits fast enough to fund redemptions. I remember in the late 1980s when Drexel Burnham sort of blew up and there was illiquidity in the junk market. And we had a phrase on the desk where these highly illiquid bonds, we used to call them owl bonds. People who weren't from the space said, "What is an owl bond?" We would respond, "An owl bond is where you call your broker to sell the bond, and the broker says, 'To who? To who?'" I have this odd sense that liquidity, the ETF holdings of sub-investment grade debt are so large and so liquid that if we have a credit scare similar to the 2008 credit scare, that there'll be no bids. And I don't know how we resolve that.
And I suppose kind of globally, we are so interlinked these days that could be triggered elsewhere at this stage. So something like what we've seen in the UK over the last couple of days could be the rug pull, the thread.
David, I'm speculating, but imagine you yourself running a very large pension fund. Heaven forbid, I understand. And the board of governors of the pension fund has said you have to increase the real yield because we don't have the ability to cause the employers or the employees to up the contributions. We have to increase the yield on the corpus. And so maybe you look at the US sub-investment grade debt yielding 7 or 7.5% in a currency that's rising, against the gilts yielding 3.2, 3.3 in a currency that's falling. And you decide, well, that's fairly easy. I can increase my real yield by going into a stronger currency and a higher yielding instrument. What I would suggest you're doing is going into a trap if you take duration and credit yield. And, some of these ETFs now are funding. In other words, they're leveraging their junk debt holdings. They are buying 7-year or 10-year obligations, and they are funding it with money market operations, which is to say that they're borrowing short and lending long. That works fine until it doesn't.
Indeed, yes. And the more leverage we become, the smaller the event that is required to start to unroll this.
Correct. So I'm on a credit strike personally. I want to only own credits that I originate or that people that I know and love and trust originate. I don't have any interest at all in Wall Street credit.
Makes a lot of sense. As usual, it's been fantastic getting the opportunity to speak to you and to pick your brains. Before we wrap up here, how can people find out a bit more about what it is that you do?
Well, if people care about my opinion around the natural resource markets, the easiest thing to do is go to my website, ruleinvestmentmedia.com. You can list your natural resource stocks there, and I will personally rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. In addition to that, David, I've taken to starting a free service where I inform people on the private placements I'm doing. I don't charge them any subscription fee yet, although I may someday. And I don't charge the companies any commission. This is just what I'm doing with my own money. For your listeners that are accredited investors, if they care what I'm doing in very risky microcap equities, when you go to the Rural Investment Media site, simply write placements in the question and comment section. I'll put you on that list. Finally, as I mentioned in the interview, I'm celebrating retirement at age 69 by starting a new bank. I would suspect that the primary asset class on the lending side with regards to this bank will be lending against individual investors' hoards of bullion in segregated storage. So if you would like to deposit money in a bank that lends against good collateral, or if you'd like to be a customer of a bank, an old-fashioned bank that had equity, that had money in it, or if you would like to look at borrowing some money against your precious metals holdings, either to increase them or to affect some liquidity, when you go to Rural Investment Media on the ranking site, in the question and comment section, simply write in bank, and we'll put you on the list to learn more about our bank.
Super. Well, what I'll do is I'm going to put a link, those two links in the show notes and description below this. And anybody that is interested, I highly recommend that you do exactly as Rick suggests there. But for now, Rick Rule, thanks for joining us again on GoldCore TV.
David, thank you so much for having me back on. I enjoy these discussions.
It's always great listening to Rick Rule, and our thanks to him for joining us on GoldCore TV once again. As well as all of the usual brilliant insights into how markets are currently operating and what we can expect to see, I also loved his take on retirement. He's starting a bank. If anything, it's a good reminder that it's never too late to start the next project, including getting your portfolio shipshape. As Rick explained in our interview, gold helps him sleep well, and we couldn't agree more. That's why we help people to buy physical gold and silver to hold as part of a balanced portfolio. If you're interested in adding the safe haven that is gold to your investments, or even buying just a few silver coins, then please get in touch with us at goldcore.com, your precious metals experts. And don't forget, if you enjoyed Dave and Rick's chat, then check out the rest of our channel for some just as excellent conversations and insights. I highly recommend our flagship show, the M3 Report, your show for all things metals, markets, and money. Past guests include Jim Rickard, Rick Rule, Steve St. Angelo, and Ed Steer. So with that in mind, you've got plenty to be enjoying, and we'll see you next time.